But then we had this massive sell-off in the markets because everybody saw the word inflation and freaking panicked and just dumped everything. Dumped absolutely everything. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of March 8th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. There we go, another terrible week. Just when you thought things couldn't get worse, they did. Thankfully, Friday was a little bit of a recovery for most of the markets, but if you had a bunch of small caps in your portfolio, chances are they did not bounce back yet. The Friday recovery was predominantly focused on a lot of the large cap non-tech stocks. Some more of the value plays are the ones that recovered on Friday, but at least there was money flowing back into equities. Now this week, I had an absolute deluge of comments in my DMs, in my comments section. Like, we're talking biblical flood Noah's Ark level of comments here, with people saying, Walrus, should I sell ABC? Should I sell XYZ? Because the market was so red, and it was, it was a little frightening if you weren't expecting it. When you're scared about your investments being in the red, ask yourself, did your investment thesis change? If yes, consider selling. If no, just keep holding. The short-term price action of a stock is irrelevant in the long run. For the last umpteen decades, stocks generally tend to trend upward. As long as it's a good company that you're holding and you have a solid investment thesis, it'll recover. The shit stocks, the bad companies that you might be invested in, they won't really recover. And those are ones that you can consider cutting losses with. But that's why you have to really be certain when you make an investment with a thesis, that you did your due diligence, that you understand the ins and outs of the company that you're investing in. For me personally, this week didn't faze me. I've actually been moving cash around in my other accounts to get more money ready to keep buying these dips. I'm going to be looking at the stocks that decrease disproportionately to the rest of the market and adding more to those positions. So if you ask me, for example, Walrus, did you sell ACRX? Why? Because the price went down? That's not a reason to sell. It's still the same company making the same products that it was 3 weeks ago, 4 weeks ago when I made my initial investment. Why would I sell? All right, enough with the lecture. Let's get started with the news. If you're not aware, I do publish my technical analysis every week. This is my practice and I am sharing it with you guys. You could find the link below the video. I had several comments last week about the confidence column specifically. This is not my confidence in the company. This is my confidence in my 1 week price prediction. Do not assume that that's my confidence in the stock overall. This is my confidence in my 1 week price prediction only. That's it. Don't read more into it than is there. That's all. First article. For any of you wondering what the heck happened on Thursday and Friday, this happened. Stocks tumble as Powell signals inflation is ahead. Jerome Powell is the chairman of the Federal Reserve Bank. Powell, speaking at a conference on Thursday, predicted strong job growth and increases in consumer prices as the vaccine rollout allows the economy to reopen fully. But he cautioned the Fed does not think the economy is at risk of overheating. This part right here, increases in consumer prices. That's a really innocuous way of saying inflation. We do expect as the economy reopens and hopefully picks up, we'll see inflation move up. US inflation is currently below the Fed's long-run target of around 2%. In fact, price increases have been rather low for a long time. Now, if you're thinking, oh my God, inflation, the world is ending. If we do see what we believe is likely a transitory rise in inflation, I expect that we will be patient. There's a difference between a one-time surge in prices and ongoing inflation. To clarify this and put to rest all possibilities of stress here, the Fed has had a long-standing goal of keeping inflation at an average of 2%. We've been below 2% for a really long time. In order for us to hit that average, we would actually have to inflate past 2% for a little while to maintain the average. I don't really think that's going to happen. Even if we go over 2% this summer, like he mentions, it's probably just going to be transitory. From last week, we talked about how jobs are the primary focus of the Fed, not inflation. There's a good reason to expect job creation will pick up in the coming months, but that doesn't mean the labor market will be fully recovered forward come December. And we haven't succeeded in this yet, but we're right there. So there you have it. We might have inflation by summer, jobs are heading in the right direction, the Fed's gonna kind of just do nothing. That's all. But then we had this massive sell-off in the markets because everybody saw the word inflation and freaking panicked and just dumped everything. Dumped absolutely everything. Now he mentions the jobs report there. The jobless claims came out. Another 745,000 Americans filed new unemployment claims. This sounds kind of bad, but there was actually 750,000 expected. So this is slightly better. Continuing claims for the week ending, we had 4.295 million versus 4.3 million expected and 4.4 million during the prior week. We're down about 126,000 continuing claims off last week, which is great. And that's actually really far down from the 10 million or so claims at the start of the pandemic. So we are making a lot of progress in the jobs market. And this is why in the previous article, Jerome Powell was very optimistic about jobs, saying that we are recovering. Senate passes $1.9 trillion COVID relief bill. House Democrats plan final approval Tuesday. Democrats had to make several last-minute changes to win support from all their members, and Republicans opposed the major spending plan, contending the state of economy does not warrant it. The Senate approved the plan in a 50-49 party line vote, as the Republicans questioned the need for another broad spending package. In light of the possibility of inflation here, you can actually understand part of the Republicans' concerns that printing another $1.9 trillion is only going to exacerbate the inflation that's already expected to be coming by summertime, but the Democrats were arguing that it's more important in the short term to keep businesses afloat, to get money to families, and then worry about inflation later. I'm not picking a side, I'm just letting you know the arguments from both parties. The $15 minimum wage. This is one of the parts that got cut from the bill. Moderate Democrats joined all Republicans to shoot down Bernie Sanders' amendment to include increasing the minimum wage to $15 an hour in the relief package. And this was a 42 to 58 vote, so this one was not close. Politically, this laid out a deep divide within the Democratic caucus on the issue, raising questions on its path forward. That's for a politics video. This is a finance channel, so do with that information what you will. But the Democrats were seriously split on the idea of the federal minimum wage hike, so we can kind of basically count that one out for the time being. On to Bitcoin. This is a really awesome report. You could get this at ir.citi.com. It is a 108-page PDF on the direction of Bitcoin. We've been talking in recent weeks about the adoption of Bitcoin, where Tesla invested into it. Other companies are investing significant portions of their free capital into Bitcoin. We talked about BlackRock's comments on it, and now we've got Citi releasing a 108-page PDF on the future of Bitcoin. Where could Bitcoin be in another 7 or so years? The report notes that the advantage of Bitcoin in global payments, including its decentralized design, lack of foreign exchange exposure, fast and potentially cheaper money movements, secure payment channels, and traceability. These attributes combined with Bitcoin's global reach and neutrality could spur it to become the currency of choice for international trade. It's really nice to see a major financial institution like Citibank acknowledging this. Spotify confirms hundreds of K-pop releases removed from the platform worldwide. It is our hope that this disruption will be temporary. Spotify actually launched in Korea earlier this month. I've been just connecting to it with a VPN up to this point. Hundreds of K-pop releases have been removed from Spotify worldwide as the streaming platform continues to try to reach an agreement with distributor Kakao M. Kakao Group owns Melon, which is the primary streaming software for music in Korea. They're claiming rights to some of these songs, some of these artists, and Spotify has not reached an agreement with them to this point. Immediately, I freaked out and I was like, oh gosh, no, not JYP. Artists signed to SM, YG, JYP, and Big Hit are unaffected by the removals. Thankfully, I could still listen to my Twice playlist at work. That helped with my mood while I was watching my portfolio tank through the basement this week. All right, let's see how the world reacted to K-pop being removed from Spotify. The announcement was made on Sunday night. Monday morning, the stock price climbed by almost $9. It's like the world doesn't even care. Dave Portnoy, Stool Presidente, the CEO of Barstool Sports, worked with VanEck and created an ETF. It's a new era of investing. Welcome to Buzz. What people are saying about stocks matters more than ever. Our algorithms are always on, analyzing stocks with the most positive investor sentiment to stay one step ahead of the market. I've been kind of saying this now since I started my channel. I'm more of a fundamental and a sentiment-based investor, and I think that matters more than technicals right now in our current market. Sentiment leads to these huge price spikes like we've seen over the last couple of months, and I love the concept of this ETF. In fact, I'm probably going to be adding to my retirement portfolio just because I want to support sentiment-based investing. That being said, there are a few problems with Buzz. Buzz uses AI to analyze investor sentiment over 15 million online posts a month. The Buzz Next Gen AI US Sentiment Leaders Index is optimized with the goal of maximizing profits, and finally, the index is adjusted each month based on the new data we gather. The algorithms follow these sites. I don't like the once monthly rebalancing because, as you guys know, sentiment can actually change multiple times per day regarding a stock, and I think once monthly is not enough for this. I really do think it needs to be rebalanced almost daily to be a true sentiment-based index. They consist of 75 large cap US stocks, so this isn't small cap, mid cap, these are large cap. It's claiming 1-year returns of 68% versus the 20% increase of the S&P 500. I can't help but wonder if this is kind of the tail wagging the dog, looking back only 1 year on social media sentiment. Why didn't they go back 5 years on this analysis? Why did they only go back 1 year when we've more or less been in like one of the biggest short-term bull markets of all time, recovering from the COVID drop? This seems a little short-sighted, and I really wish they would have back-tested this about 5 years or 10 years. We've had social media that long, so I'm not exactly sure why that wasn't done here. It's still something cool, and I'm probably going to be investing part of my retirement fund into Buzz, just for kicks, just because I want to support this style of investing. Sensonics reported their earnings. It kind of sucked, but we expected it to suck. If you followed the stock and if you watched my video on Sensonics, you kind of knew this was coming. So they generated a fourth quarter revenue of 3.9 million. They raised proceeds. We saw that with the stock sales. Ascensia initiated EverSense sales and marketing activities in Europe on February 1st. They added codes to Medicare. They reduced expenses. The downside is year on year, the revenue is significantly down, but we knew that was going to happen because the company shuttered itself for COVID, and also Roche wasn't doing a very good job marketing the EverSense product. Ascensia took over on February 1st. The quarter 1 2021 earnings report is going to have 2 months of sales with Ascensia. The quarter 2 2021 earnings report is going to have 3 months of sales with Ascensia. So if you want to get a feel for the way this company is actually going to be performing financially in the future, you actually have to wait until quarter 2 2021 earnings to see the full value that Ascensia is bringing to the company. So once again, this wasn't a great earnings report, but it was expected. We also talked about Smith & Wesson last week. They had a huge beat on their earnings report by 36 cents. And we saw this all year, beat with Smith & Wesson. We talked about the correlation with the news events with Smith & Wesson. Quarterly earnings of $1.12 per share, beating out the estimate of 82 cents. Earnings surprise of almost 37%. Great earnings. On the charts though, you'll see that Friday, the stock price just tanked after earnings. So the earnings didn't have any effect on Smith & Wesson's actual share price. That could have been a factor of the larger market redness at play between Thursday, Friday, and people just getting into large cap values on Friday. Or it's just following the trend of all the other companies that report great earnings and then the stock tanks. Not really sure, but the earnings were stellar. Let's quickly take a look at the upcoming earnings for this week. Kind of a boring week for earnings. We've got Shift, which is a used car sales company, kind of like Carvana and Vroom, reporting Monday after close. We've got Wish after close on Monday, which is one of the fastest growing e-commerce retailers. Dick's, I just wanted to say the name. I don't have anything important to add there. Campbell's Soup Company, I do want to take a look at them because this is what you consider a consumer staple. It's always a nice reinforcement to look at their charts in moments of market volatility. We've got Skills after close on Wednesday. This was another recent IPO off a SPAC merger, kind of like DraftKings, but Skills is for gambling with esports. And Microvision on Thursday after close. I get a lot of requests to cover Microvision, so I might as well just use this opportunity to take a look at it. Let's go into Webull. First up, I do want to take a look back at the Sensonics chart. We did have that huge rise up to 556, and even with the subpar earnings this week, we seem to have found some resistance here at the 50 MA, and we didn't really drop below it. Also, this is kind of a support resistance line for a while now with the company, right around 250. Dropped a lot lower, but then we came back up. I think this might be the bottom for SENS. RSI is looking a little oversold, and we had some decent volume on Friday. I wanted to take a look at Ford. Ford was one of the only like green stocks in my portfolio last week. This was just lovely to see. Ford's in a little bit of hot water right now. They're working with SK Innovation, a Korean company, on their EV batteries, and they've kind of ignored American EV batteries to work with South Korean battery makers, and this landed them in a lot of hot water. If you look at the news this week for Ford, there's a lot of people talking about that issue. That being said, it didn't affect the stock price in the damnedest. Neither did really the red market. You know, we had a nice little climb up here with Ford, and we finished the week above where we started it. Really strong movements, especially considering I'm long on this stock as an EV play. Also, we had news the Mustang Mach-E sales are starting to eat into Tesla sales, and the early reviews on the Mustang Mach-E are really good. All right, this week earnings, let's take a look at Wish. So Wish just IPO'd back in December 16th. On its first earnings report, it reported that it lost money, but it's still expanding, spending a lot of money on marketing, advertising. Everybody kind of understood that, went up, and then precipitously dropped off. We ended up dropping down to this like 1750 level before rising back up and dropping back off. We closed at 1777, went up to $18 after market. Because Wish didn't drop on its last earnings report, which was kind of negative, and because the market as a whole has dropped so much, I would actually bet on Wish rising this week with the stimulus coming, with the fact that it's at its lowest valuation of all time, the fact that 11 analysts are rating this as an average of a buy, with price targets ranging from $22 to $40 a share in the next 12 months. Wish is kind of like a discount e-commerce platform. It is one of the fastest growing e-commerce platforms. So there's a lot going for it right now. Its price is at an all-time low. I think this got caught up in the tech sell-off, and this is a pretty strong bet to rebound this week. I think I'm going to play some at-the-money 2-week call options on Wish. Here's the chart for Skills. The merger closed on December 17th, and they started being traded as Skills. They increased all the way up to 46.30 before dropping back down here to 27.45. This is going to be their first public earnings report this week, so I don't really know what to expect from them since we don't really have any guidance. The analyst projections for this one are an average of a buy with 3 strong buys and 2 holds. Price target from 28 to 34, so there might be a little bit of value here for Skills. This is Microvision. It was a former penny stock. It deals with laser beam scanning, LBS technology used in applications like LiDAR. You've had this huge run up basically since December. We went all the way up to $24 a share for MVIS for Microvision. Currently we're down to $12.82. RSI is dropping real hard. MACD's downtrending. Volume's just about evaporated. And I was curious what this company's financials were. If we take a look back at their earnings reports, every time they report earnings, they drop. So there's one drop. Here's another earnings drop. Here's another earnings drop. Here's another earnings drop. You guys get the idea. They just drop on earnings. And I was curious as to why. The revenue is like almost nothing. Q4 2019, they had 4.6 million revenue, down to 1.4, down to 587,000, up to 639,000. This company is struggling for money. This is one of those ones where if you buy into Microvision, you need to be prepared to hold for a really long time because they're just not making as much money as they should be to justify the valuation. And if you're wondering what I mean, even if you take a look at their revenue in their most profitable quarter here, 2019, 4.6 million revenue, their market cap right now is sitting at almost 2 billion. This seems to be way overvalued. Last but not least, I do want to take a look at Campbell's Soup. I know, super boring. This is the big drop for COVID, and we had a run up here at the end of January and then a drop back down. The run up coincided with some news articles, and also at this time we had a big sell-off in the market. Campbell's Soup is what you would consider a consumer staple, and it is a stable, mature company that pays out a decently high dividend but returns with very little growth. This is one of those companies that in times of market unrest you park your money in. It does nothing really but pay you a dividend. They are paying above a 3% dividend, 3.23%. And if we just zoom in to the last week where we had this big market sell-off, right? Thursday was the Fed announcement. Friday was a little bit of a recovery. But Thursday, you could see on the Fed announcement, we're slowly picking up pace. When people are unsure about the market, they transfer money out of risky stocks into consumer staples. Consumer staples give people that peace of mind that they're not going to lose a bunch of money. In the meantime, they can collect some dividends, but they're also not going to be getting rewarded with a lot of growth. That's it for the news and earnings this week. Hope you guys enjoyed it. Took a look at a couple of companies that maybe aren't the most common ones, but they're always good ones to consider about, and it's good to understand and expand the types of companies that you look into. I guarantee nobody gets excited about Campbell's soup, but in times of market unrest, it's a good one to know about. I will be releasing a DD video this week. I was planning on taking a little bit of a break, but maybe I'll take the break next week because there was a really good value buying opportunity that I identified this week off something that dropped disproportionately to the market. So I will be releasing that video at 9:45 a.m. on Monday morning Eastern time. I hope you guys enjoy it. As always, if you're liking the content, please like the video, subscribe to the channel, and if you want to be alerted to all my content as soon as it goes live, make sure you hit that notification bell. Also, if you're new to investing and you want to support my channel, one of the best ways to do so is to use my Webull referral link below the video. If you sign up, create an account, deposit $100, you get some free stock, I get some free stock, everybody's happy. Also, because I'm in the Webull partner program, the free stock that I get is actually valued $30 or higher. Basically, it's like you sending me $30 for free. I like it. All right, everybody. Hope you enjoyed. Have a great week. I wish you some green portfolios and good growth coming off the back of the COVID stimulus news and these awful, wretched red weeks that we've been having lately. Cheers.